What if I told you that in just 48 hours, a single stock became the epicenter of a $3 billion financial bloodbath? And right now, while most traders are panicking over a pre-market dip, the smart money is quietly asking one critical question. Is this pullback the last real buying opportunity before this name rockets to levels nobody saw coming? Welcome back to Calvin Mateo, where we tear apart market structure to give you the edge that Wall Street doesn't want you to have. Today, we are ripping open the full tactical dossier on Palantir Technologies, and by the end of this breakdown, you will know exactly how this massive move happened, why the current pullback is not what it seems, and precisely how the sharpest traders are positioning themselves for the next explosive leg. If this is your first time here and you want to stay ahead of moves like these, hit that like button and subscribe to the channel right now so you never miss another high conviction breakdown. Now, let me show you exactly how severe the damage was for anyone betting against this tech giant. Look at these numbers on your screen. A single session 29.45% explosion on an absolute mountain of volume, 175 million shares traded in just 6.5 hours. That massive surge did not just materialize out of thin air. It became the catalyst for a staggering $3 billion in mark-to-market losses inflicted directly on bearish short positions. But here is where things start to get really interesting. As we speak, the stock is showing signs of cooling off, trading down near the $153.75 level in the pre-market. Now ask yourself this: what if this pre-market drop is not the beginning of the end, but rather a mathematically necessary, market maker-driven pause that is quietly setting up the ultimate buy the dip opportunity? Could this be the kind of engineered pullback that only happens once before the stock leaves this price range permanently? We are going to dig into exactly why this pre-market drop might be a structural gift in just a moment. But first, we need to trace the exact moment this fuse was lit. If we rewind to Monday, the stock was quietly sitting in a defensive pattern, completely unaware of the explosive catalyst that was about to drop. On Monday, Palantir was trading at $125.65, sitting right at the apex of a multi-month symmetrical triangle. Technically speaking, the stock was tightly compressed, coiled like a high-tension spring, loaded with months of pent-up energy. Bears were confidently stacking positions, fully expecting dynamic moving averages to hold as heavy overhead resistance. But when the earnings print hit, that technical apex was not just broken, it was completely annihilated. On Tuesday morning, the stock bypassed days of potential consolidation, gapping up straight to $145.15. That single gap up vaulted over a massive amount of historical overhead supply, instantly shifting the power dynamic and putting every single short seller on their back foot. But gapping up is only half the battle. What happened during Tuesday's regular session is what turned a standard breakout into an event that will be studied in trading textbooks. Once the opening bell rang on Tuesday, many traders expected a standard gap and crap scenario where early buyers would take profits and push the price right back down into the gap. Instead, what unfolded was a relentless, high-volume buying campaign that refused to let up. Demand was so overwhelming that the stock closed near its absolute intraday high at $162.66. That represents a stunning 29.45% regular session gain on 175 million shares. To put that volume into perspective, that is roughly 4 times the recent daily average. When you see that much volume accompanied by a price vector that only points in one direction, it tells you that major institutions are aggressively accumulating shares at scale, leaving retail traders scrambling to catch up. And here is a question worth sitting with. What happens when the institutions that drove this buying campaign have not even finished building their full positions yet? Now, a move of this magnitude simply cannot be sustained indefinitely without some level of exhaustion, which brings us to Wednesday's tactical shift. On Wednesday, the stock tried to maintain its vertical trajectory, pushing higher to test a key intraday resistance ceiling at $166.08. However, as the initial buying frenzy began to cool, early buyers started locking in their gains, leading to a period of constructive, orderly profit-taking. The stock ultimately pulled back to settle the session at $158.43. What is absolutely crucial here is the character of this pullback. It was not a violent rejection or a panic sell-off. It was a healthy, orderly consolidation that allows the technical indicators to cool down after becoming extremely overextended on the hourly charts. When we step back and map these individual daily candles together, a clear 72-hour structural roadmap starts to emerge that every serious trader needs to understand. We start on Monday at that triangle apex of $125.65. Tuesday morning brings the massive gap open at $145.15, which is immediately followed by a vertical run to close the day at $162.66. Wednesday brings a peak test at $166.08 before we get that orderly settlement back down to $158.43. For short-term traders, this is not just historical data to file away. This 72-hour map serves as the absolute physical foundation for the actionable trading setups we are going to lay out in just a few minutes. To figure out where the stock might stall next, we have to look closely at the heavy supply of sell orders sitting just above Wednesday's highs. If we examine the chart from a volume at price perspective, we find a highly stubborn overhead supply zone stretching between $163.50 and $166.08. This is a critical area on the chart where prior buyers who were trapped during previous pullbacks are finally seeing their positions return to break even, creating enormous temptation to sell. Additionally, short sellers are actively using this zone to initiate fresh bearish positions, betting that the stock's near-term momentum is hitting an impenetrable wall. If you are thinking about chasing the stock higher right here, you need to understand that this supply zone represents a formidable barrier that will likely require multiple attempts to break through. But what if those trapped sellers exhaust their inventory faster than anyone expects and this wall crumbles in a single session? What is even more fascinating is that the sellers in this zone are not just retail swing traders. They are part of a much larger, highly painful short covering dynamic that is still actively unwinding. Let me pull back the curtain on the real mechanics of Tuesday's rally, because this was a classic, violent short squeeze operating on multiple levels simultaneously. It starts with the ignition point, the unexpected technical breakout and gap up that caught bears flat-footed. As the price surges past their entries, it hits the pain threshold of bearish investors who have built concentrated short positions. To stop their losses from spiraling out of control, these shorts are forced to buy back shares at any price, creating a wave of involuntary buying pressure. But here is the hidden amplifier that most people never talk about. Options market makers who sold out of the money calls are simultaneously forced to buy the underlying stock to keep their books delta neutral. This dealer hedging, combined with short covering, creates a self-reinforcing feedback loop that drives the price vertically higher with almost no resistance, culminating in that staggering $3 billion in mark-to-market bearish losses. This options market hedging loop is highly visible on the derivatives chain, where a massive structural barrier is currently holding the stock in a very specific range. If we look at the options chain, we can see exactly where the market's leverage is concentrated. There is a massive crowding of open interest around the $160 and $165 call strikes. In derivatives trading, we call this concentration a gamma wall. When the stock trades near these levels, options dealers must buy or sell millions of shares of the underlying stock just to adjust their hedges. Currently, this concentration is acting as both a strong upside magnet, pulling the stock toward it, and a structural ceiling, pushing it back down when it arrives. If the stock cannot decisively break above this gamma wall, the options market will actually work to suppress further near-term price gains as the weekly options approach their expiration date. But think about this. What happens if a sudden catalyst forces dealers to flip from selling into buying right at the wall? The answer is a move that could dwarf what we already witnessed on Tuesday, and that options market pressure is exactly why we are seeing the stock pull back in the pre-market right now. This brings us to the pre-market action, where Palantir is currently trading around $153.75, down from Wednesday's close of $158.43. Many retail investors are staring at this drop in panic, convinced the rally is completely over. But if we dig beneath the surface into the market structure, this pullback is a completely natural, dealer-driven event. As the initial short squeeze momentum cools and the weekly options draw closer to expiration, options dealers are aggressively unwinding their long stock hedges, booking their profits on shares they were forced to buy during Tuesday's frenzy. This profit taking by market makers creates temporary, artificial downward pressure, pushing the price lower even though no major negative fundamental news has occurred. The question you need to ask is simple. Are you going to let algorithmic hedge unwinding shake you out of a position before the real move even begins? Rather than being a reason to panic, this dealer-driven pullback is actually delivering the stock right into a highly formidable support zone that could act as the launchpad for the next leg higher. If you are looking for a low-risk entry point, you need to pay close attention to this tight $1.46 support range. It is a powerful confluence zone consisting of three distinct structural layers. Layer 1 is immediate breakout support at $154. Layer 2 is Morningstar's fair value estimate at $153. And Layer 3 is the major institutional benchmark, the 200-day simple moving average, which is currently sitting at $152.54. When you see structural breakout levels, institutional moving averages, and fundamental valuation targets all aligning within such a tight range, it represents an incredibly strong floor where buying interest from the biggest players in the market is highly likely to step in with conviction. Now that we have mapped out the complete technical landscape from the breakout to the squeeze to the pullback to the support, let us translate all of this data into specific high conviction trade setups you can actually execute. Our first actionable setup is a classic bullish pullback rebound. The plan here is to catch the mean reversion bounce right as the pre-market dealer unwinding exhausts itself inside our confluence support zone. We are looking to establish a long position in the entry zone between $151.43 and $154. To manage our risk with precision, we place a tight stop loss decisively below the 200-day moving average. This setup offers an exceptional risk-to-reward ratio, allowing us to risk a very small defined amount of capital to capture a potential run back up toward the high 160s as buying momentum returns. The key to this trade is patience. You do not chase, you wait for the price to come to you. But what if the stock does not pull back? Or what if it rallies back to retest those highs and starts to show clear signs of exhaustion? That is where our second playbook comes into play. Our second setup is a counter-trend trade called the bearish resistance fade. This is a short-term strategy designed to capitalize on trapped buyers and localized exhaustion at the overhead supply zone. If the stock rallies back up to retest that heavy overhead ceiling, we are looking to initiate a short position in the entry zone between $163.50 and $166. We place a strict stop loss decisively above the Wednesday high of $166.08. The logic here is straightforward. If the stock cannot clear that heavy overhead supply after multiple attempts, early buyers will quickly begin liquidating their positions, creating a wave of selling pressure that drives the price back down toward our key support levels. Let us compare these two setups side by side so you can see exactly how each one is structured. The bullish rebound is a long play based on mean reversion, with our primary entry between $151.43 and $154, using the 200-day moving average and fair value as our key structural defense. The bearish fade is a short play based on technical exhaustion, with our entry between $163.50 and $166, using the gamma wall and overhead supply to protect our downside. Both of these setups are highly structured, meaning we know our exact entry, risk, and target parameters before we ever put a single dollar of capital to work. There are no guessing games here, only disciplined execution. As we prepare for the market open, here is your definitive pre-market checklist to keep you disciplined and focused while everyone else is reacting emotionally. First, set a price alert at $154 and monitor for a constructive, high-volume entry trigger inside the confluence zone. Second, set a price alert at $163.50 to watch for signs of exhaustion if the stock attempts another run at the overhead supply. And finally, keep a close eye on the options flow, watching how the volume decays or expands at the 160 and 165 call strikes during the opening hour of trading. Successful trading is never about chasing the noise or reacting to every tick on the screen. It is about executing a structured plan with absolute discipline and letting the probabilities work in your favor over time. Now, before we wrap up, I need to be completely transparent with you. Nothing in this video constitutes personalized financial advice. I am not a licensed financial advisor, and the information presented here is strictly for educational and entertainment purposes only. Every trade carries risk, including the risk of losing your entire investment. Always do your own thorough due diligence and consult with a qualified financial professional before making any trading or investment decisions. Past performance is never a guarantee of future results. With that said, here is the bottom line on Palantir Technologies right now. We have a stock that just delivered a historic 29.45% breakout, fueled by a $3 billion short squeeze. And instead of flying off into the stratosphere, market structure is engineering a controlled pullback right into a zone where three layers of institutional support converge within $1.46 of each other. The smart money is not panicking over this dip. They are watching it with laser focus, waiting to see if this confluence zone holds, because if it does, the next move higher could make Tuesday's rally look like the opening act. This is Calvin Mateo. I want to hear your take in the comments. Do you think this pullback holds and we launch to new highs, or are the bears about to take back control? Drop your analysis below. If this breakdown gave you a tactical edge, smash that like button and subscribe so we can keep building this community of informed, disciplined traders. I will see you in the next one.